Let's look at the data. We're seeing a major market divergence right now, and folks, it's something that absolutely demands our attention. Okay, check this out. On December 17th, the headlines were just screaming negativity, right? The S&P 500 was in a 4-day freefall. Tech was getting absolutely hammered, and the bears were in total control. But then you fast forward just 24 hours, and the tape is telling a completely different story. We're talking a broad-based rally, with the major indices snapping those nasty losing streaks. Now, this is exactly the kind of anomaly we hunt for, a sharp, undeniable contradiction between the prevailing sentiment and the sudden price action. So the critical question is, what on earth changed in just 24 hours? What was the catalyst? What force was powerful enough to completely reverse the market's trajectory in a single trading session? This isn't just random noise. This is a structural shift, and it was driven by new information hitting the market hard. To really get the pivot, you have to appreciate the pressure cooker environment on the 17th. We had a multi-day bleed in the major indices. That high-flying tech sector, especially the AI and quantum computing names, was going through a serious pullback. The narrative was simple and everywhere. Fears of an AI bubble were taking over, and the big institutions were de-risking into the end of the year, pulling liquidity right out of the market. But then, boom, the script just completely flipped. All that bearish momentum, it hit a brick wall. And it all came down to a single, high-impact economic release that caught the consensus totally off guard. And here it is, the November Consumer Price Index. The year-over-year headline number came in at 2.7%. Now, for those of you who track this stuff, you know that in the world of economic data, this was a colossal miss to the downside, a crystal-clear signal that inflation was cooling off way faster than the market had priced it. Just look at the velocity of this change. We dropped from 3% in September all the way down to 2.7%. For a market that has been obsessed with every single tick in inflation, this was the giant green light it was waiting for. It immediately forced a repricing of what the Federal Reserve might do next, and you saw capital begin to aggressively pour back into riskier assets. And the reaction was immediate and, frankly, violent. The tech-heavy NASDAQ led the charge, just ripping up 1.38%, a direct refutation of the weakness we saw the day before. The S&P followed right along, and even the Dow managed gain. The crucial point here, guys, is that this wasn't just a bounce. It was a broad, data-driven reversal across the board. But the CPI data wasn't the only catalyst here. We also got a secondary confirmation, this time from Micron Technology. Their earnings were a blowout, and their forward guidance was strong, specifically calling out AI-driven demand. This was a direct counterpunch to that whole AI bubble narrative that had been spooking the market. It was like a fundamental tailwind that just ignited the entire semiconductor and tech space. So a macro catalyst triggers the reversal. The next logical question for us is, how do we see what the institutional capital, the so-called smart money, is actually doing? How do we track their footprints to confirm if they're actually buying into this new narrative? Well, one of the most powerful tools we have for this is the 13F filing. Now, think of these as quarterly disclosures from the really big investment managers. Yeah, there's a bit of a reporting lag, but they give us this clear X-ray vision into where massive pools of capital were being positioned in the months before, and it shows us their conviction in certain sectors and individual stocks. And this just illustrates the sheer scale we're talking about. These are not small players. Look at the number of positions held by firms like Tudor Investment or Strategic Investment Solutions. They're deploying billions of dollars, and their movements are what create the institutional flows that drive these major market trends. Analyzing this data lets us align our own strategies with these massive capital flows, instead of fighting against them. Okay, let's put it all together. We've got a clear macro catalyst with that cooler inflation print. We've got a fundamental catalyst from strong tech earnings, and we have the tools to track institutional positioning. So what's the forward-looking thesis here? What's the outlook? Well, the bull case is pretty straightforward, that CPI Miss gives the Fed cover to ease up on policy, the strong earnings provide real fundamental support for tech, and you've got positive seasonality that could carry us higher into the year-end. The bear case, however, is our reminder to manage risk. Those AI bubble fears, they haven't completely disappeared. Volatility could easily spike again, and you've always got geopolitical issues in the background that could present a threat. The bottom line is, we have to stay data-dependent. And I need to be absolutely explicit here. This analysis is for educational purposes only. It is based on data that is changing constantly, by the minute. It is absolutely critical that you do your own due diligence before making any trading decisions. We're tracking these flows in real time every single day. So while you analyze your next move, check out the tools in the description. You can sign up for Public and get $20 in free assets, check Webull for their BTC promo, or look into NVIDIA on Moomoo. All the links are right down below. And hey, if you like this kind of deep dive analysis, do us a favor and hit that like and subscribe button. All right, that's all for this one. The key takeaway here is that one data point can change everything. So remember the plan, watch the key levels, and as always, stay disciplined, stay liquid.